Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Hello and welcome to today's webinar, where we will be discussing investing during uncertain times. My name is Jake Lusher, and I'm a financial advisor here at Savant. Now, over the years, there have been numerous uncertain times, and of course, off the throes of the most recent political election, it might feel like uncertain times to you as well. So today we want to discuss 5 best practices to help you. Joining me today is fellow financial advisor, Jessica Knudsen. Thanks for joining us, Jessica.
Thanks, Jake. I'm excited to be here and jump into this topic and hopefully help some of you that might be feeling anxious about what's ahead.
Great. So we're going to jump right into today's agenda. So we've got a number of topics that we're going to discuss with you. I will kick off today's agenda talking a bit about kind of the fundamentals and also the historical data. Jessica will guide us through some of the opportunities where we can actually manage risk with some strategic intent, and then figuring out how this all fits in with a financial planning context. So we're looking forward to jumping right into the overall process. So starting with sticking with the fundamentals, there's a number of what we call core investment beliefs that we have at Savant. I'm certainly not going to read the description of each one of these on the slide to you. I would even add one more core investment belief to this, which I feel is paramount. Oftentimes when an advisor is hired, they'll focus on these core investment beliefs, just like Savant has our own investment beliefs. But as the end investor, you also have some of whatever responsibility. And I would argue that one of the most important responsibilities and fundamental belief system, which should be part of managing an investment portfolio, is discipline. Discipline is an important part of this process, and you'll see that echoed kind of along the way throughout our presentation. But ultimately, discipline and how it relates to someone's financial plan, and then influencing asset allocation based on some of these elements of historical data, or as we call them, evidence-based investment principles, are a lot of what I'm going to plan to discuss here in the next several slides. But I think the key tenements of financial plan being integrated with your asset allocation, understanding that markets are efficient. We don't, have a crystal ball, but for the most part, every moment of every day, decisions are being made to the point where it's hard to take advantage of things people don't know, or otherwise known as inefficiencies. So elements of that being related to, risk and return and how your portfolio is built, where in the world you should invest your money, how expenses play a role in that, and how strategic decisions like rebalancing impact those things are all part of kind of the fundamental belief system as advisors that we believe in. But of course, the discipline piece is interwoven throughout all of this. So getting to some of the detail about the fundamentals, human beings often forget things that aren't very good, but they tend to remember things that are very good, except for, of course, those bellwether moments where we have a scenario like 2008 and 9, where we went through a great recession, or perhaps the pandemic in 2020, or even before that, the tech bubble. We always remember these periods which are very difficult, but in a given calendar year, we tend to forget normal volatility. So what this chart attempts to display is it looks at a calendar year return of the US stocks, where it displays the overall ending point for the return in a given year, identified by either the green bar or the red bar. So for example, in 2023, you see the green bar ended at about a positive 25% return for US stocks. That's the top of the green bar. Whereas in the previous year, in 2022, you can see that stocks ended the year down 20%. Now, you might be wondering what the overall line above and beyond the green and the red bars represents. Well, that really represents the very highest point the market got to that in that particular calendar year on the top end. And the bottom end is the very lowest point that the market got to in a given year. The point of this is markets are very variable and volatile, and we go through a lot of day-to-day volatility, month-to-month volatility, whether it's around elections or around other geopolitical conflicts or around economic policy shifts. All of those things happen all the time. We tend to just remember the final result. So thinking about the fundamentals and how this could ultimately impact you, discipline helps you to ensure that you're not going to act on those edges. And over a long period of time, hopefully you're rewarded for those types of things. Now, what do average investors do? Well, when we think about asset allocation as it breaks down to your average investors, As I said before, we are human beings. We tend to react. And when we react, sometimes it's a decision that we think is a good decision at that time, but we only have the benefit of hindsight to know whether it was a good decision or not. But what you displayed on this chart was kind of identifying the index return for the S&P 500, the largest 500 stocks, and also what we call the U.S. Aggregate Bond Index, which is a collective of all U.S. what were called intermediate term bonds. And on the far right side is inflation. Now, where you see the words average stock fund investor or average bond fund investor, those are the actual realized investment returns folks have earned, although the indexes they represent or they're tracking have earned far more return. And that's simply just a measurement of behavior, because people will get out at the wrong time, get back in the markets at the right time that they might think it's the right time, but ends up being the wrong time. And those elements of being undisciplined and not sticking to the fundamentals can prevent, in this case, 1% per year return less over a 20-year period, which can be the difference in someone's retirement cash flow for a very long period of time. And it's interesting to note that even in bonds, the average bond fund investor return is actually negative, even though holding bonds to maturity and earning a little bit of dividend and income over a long period of time, can obviously provide a very stable yield. The average bond fund investor is getting in and out of bonds all the time to try to get back into stocks. So discipline has a cost to the extent you don't have that built into your overall financial plan. Now, what are we talking about with asset allocation? Well, a lot of this is based on kind of evidence, right? So when we think about asset allocation being the most important decision someone can make, meaning how much you put in stocks versus bonds versus cash investments, perhaps alternative investments, that mix is very important. And Jessica's going to hit on this a bit later. But what I will say about this is that there were numerous studies done in the last 30 years that tried to attempt at looking at what will be the largest reason why someone will have a long-term investment return. And the biggest reason someone will have a long-term investment return, whether it's higher or lower, will specifically be related to how much risk they take in financial markets, how they allocate their investments. I think everyone knows that you don't want to put all your eggs in one basket, but not everybody knows that you shouldn't otherwise thinking about trying to get in a market at the wrong time or the right time, or trying to identify the very best security to put in your portfolio. Those aren't as important factors. What's most important is figuring out what the overall recipe is going to look like, your asset allocation, because that piece will drive most of your return as opposed to those other factors, which you can get caught in making some bad decisions potentially and having real loss of return and portfolio value and real dollars. So what do we mean by the market timing piece? Well, this chart, it kind of looks at a period of time where if you were an investor over this 33-year period, and you were not as disciplined and instead decided to try to get into the market at the right time or sell out of the market at the right time. This represents someone that every time the market fell 3% or fell 5% from its top watermark in that particular given year, that they would sell, and every time it recovered 3% from its bottom watermark would get back in. So this idea of trying to sell at a relative high and buying back at a relative low. But what actually happens over a period of time when someone has that kind of discipline or that choice of doing that, you actually flip it. So you're oftentimes selling at relative lows and buying back at relative highs. And over a long enough period of time, that has a real impact in terms of both the dollar return and also the percentage return. So beginning in 1990, if you just had $10,000 to invest and you simply bought an index of the S&P 500 and you held on to those index of 500 securities and you never made another change, your $10,000 investment turns into $211,000 of investment. That's pretty good. And if you have those moments where you're actually trying to time the market and get out at the right time or get back in at the right time, that element of kind of having discipline with your investment process, you can see there's a substantial difference in just the realized return, but also the dollar return is less than half of what you'd earn by just holding on to it and trying to ignore some of the other forces which may attempt to make you make bad decisions. So market timing can have a real cost to the extent someone is doing it. In this example, this is an example of someone that might do it twice per year for a 33-year period of time, which when you think about it is not very often, because we're presented as investors with many, many opportunities to do this regularly. And trying to stay the course is very, very difficult. If we look at this just on a more granular level, and you're thinking about that same length of time, that same 33-year window, but instead looking at $1,000 of investment over that same window, obviously the total dollars you gain over a longer period are less, right? So being fully invested in that buy and hold strategy and earning that compound return of 10.5% per year, well, you get $27,000, right? So you get a nice return over that period of time just on $1,000. But if you just miss the one best day out of that entire 33-year window, which best days tend to happen after the worst days, if you sold out on the worst day and you missed the very best day to recover within that 33-year window, that's a $3,000 mistake. What about the 5 best single days? Well, now your return is dwindling significantly, down $10,000. And obviously you can see the impact of missing just the best single days in that window. Little decisions can have large impacts. So trying to stay in the boat, even though it gets rocky and the ocean's rough and it's hard to stay disciplined, being disciplined and having that as a kind of a core fundamental investment belief is critical to this process. But what about the experts? So I put experts in air quotes because there are folks that are on Wall Street or in different fund companies that are attempting to beat their market averages, because if they beat their market averages of the index they're otherwise attracting, they may get a lot more investors in their fund, which would help them be more profitable for their own companies. Well, a lot of times you have these firms that are trying to buy the very best stocks within, for example, the S&P 500. So in this example, if we're looking at kind of a 20-year window ending in 2023, and you are owned the S&P 500, well, just the index returned 9.8% per year. Your average US large company fund, which attempts to beat that index, because a lot of times that average US large company fund is trying to time the market or identify the very best stocks within that market to own to beat the market, even the experts fail to beat the market on a regular basis. So kind of getting this idea that if the end investor, if the retail investor, you and I, if we can't do it ourselves, the experts surely should be able to do it. But you can see here on this chart, whether it's US companies that are large, medium, or small companies, or even overseas, it becomes difficult for even the so-called experts to beat their market averages or the indexes over time by trying to outsmart the market. So digging deeper into kind of the historical data, again, kind of coming back to the evidence-based investment approach that Savant employs, you kind of have to look at, okay, what does history tell you of how you should invest a portfolio? Well, from a historical perspective, this is, again, just the S&P 500 over a nearly 100-year period of time, going all the way back to 1926. This represents many good years and many negative years. Well, what does this tell us on the surface? Most of the time, the market goes up. 74% of the time in this almost 100-year window, the market was positive. 26% of the time, it was not. But I think if you take a closer look, what you actually see is that there are more really good years and a lot less really bad years. There are certainly some really bad years, like if you look on the far left-hand side, 1931 stocks were down 43.5%. Of course, you see 2008 in that next window. 2008 stocks were down about 37%. If you follow along very nicely here, what I mentioned this before, when there are bad days or bad years, usually bad years are followed by good years. The most recent example of this was 2022 and 2023. We went through a 20% loss in 2022, which is on the left-hand side. But then right away in 2023, got a lot of it back. Markets were up 26.5%. So if you decided in 2022 to sell out of the market because you thought, well, it could only get worse from here, stocks are down 20%, I expect them to get worse. You missed the opportunity to have the very strong return the next calendar year, because that most of the time what happens. And as I mentioned before, most of the time what happens, regardless of this opportunity set and the data we're showing you here today, most of the time the market goes up, right? And so we have to think about volatility in those downside years. Is that's really the price you pay. Having to stay in the boat and be disciplined is the price you pay to earn long-term return. And most of the time you are rewarded. So this chart is one of my favorite charts to talk about within kind of investment markets and financial services. So it's kind of busy, but one question I always like to ask when I'm talking to somebody individually is trying to determine whether there's any kind of discernible pattern. or if this looks more like a quilt, right? It's really not a pattern, but it's fun if you're looking at it individually year by year, because what happens here is that we've kind of looked at each calendar year going from 2007 to all the way to 2023. And the left-hand side is the legend of the colors. So U.S. large companies, that second one down, for example, is dark blue. And all that is attempted to do is to rank the very best performing index, well, the indexes are on the left, to the very worst performing index in a given calendar year. So picking on 2007 as an example, that's that light green color. That was emerging markets index. 2007 was up 39.5%. So if you had the attitude of, well, it can only get better from here, it's up 39.5%, let's stay invested in emerging markets. And you look at the very next year, 2008, the very best performer in emerging markets in 2007 was the very worst performer in 2008. Well, if you decided 2008 that, boy, emerging markets down 53.5%, we're going through a global financial crisis, there's no way we're going to get a recovery of any kind in that asset class. Well, if you decide to abandon ship, look what happens in 2009. All of a sudden, it jumps back up to be the very best performer. Emerging markets is up 78.5%. And that same kind of analysis can be done year by year for each one of these asset classes. A couple of points to be made. Number one, just looking at this 15-year window, and this is more common than not, there's never been a repeat performer. So the very best asset class in one calendar year has never been the very best asset class in the following calendar year. It's totally variable, it changes all the time. Well, how do we think about this process? Well, we think about this process as trying to identify owning it all, right? Thinking about asset allocation. What does the recipe need to look like? And if you took a mix of about 75% in stocks and about 25% in bonds, and that's represented by the purple here, the good news is, from a diversification perspective, you're never the very worst performer in any given calendar year. The bad news is, of course, you're never the best performer, so you have to take a little bit as it comes along. But if you follow along, the purple kind of stays always somewhere in the middle, which is when you're thinking about leaning on a portfolio to grow for your future, whether you're accumulating assets for retirement or other purposes, or when you have a nest egg that you're leaning on for cash flow, whether you're in retirement or you have other short-term needs, consistency in return is more important than being the very best. Because sometimes if you're the very best, you can be the very worst, and it can kind of jump all over the map here. On the far right-hand side of this chart, we kind of identify some of the benefits here of the diversification side. Again, number one, the best average performer of this 15-year window was U.S. large stocks, 9.5% per year. And it has what's called a volatility measurement. That's we call that standard deviation in our industry. That just means how much the return varies from its average year to year. So U.S. large companies, while they had a 9.5% return, it varied quite a bit. So it was either 21% higher or 21% lower most of the time. Well, that global mix of both stocks and bonds, again, bad news is you're not the best performer over a 15-year period, but you still earn a modest rate of return of about 6% per year. But if you look at that risk number, the risk number is significantly lower, even though most of your assets are still in stocks. So you get more than half of the return of the S&P 500 having both stocks and bonds, but you do it with almost 50% less volatility risk, which is kind of the whole point of diversification. But the point of the data here is to really know that there is no discernible pattern. We don't know more than anybody else. Neither does any expert know what's going to do best this year or the year after or the year after that. And trying to attempt to what's going to happen or predict which ones are going to be the very best the following year or the year after that is really a fool's game. So fresh off of another presidential election last night, of course, the conversation comes up every 4 years. How will a new president, impact my hard-earned dollars as I'm continuing to save them for my future? I love this chart because it just very simply says two things. Number one, presidents change regularly. And number two, if you look over a long enough time period, stocks go up in value, and it doesn't matter who the president is. A little piece of information and data here that isn't on the chart, which I thought I'd share. If you look at just the return of the S&P 500 over this 100-year period of time, and you looked at just the return under Democratic presidents, the return under Democratic presidents historically is 10.1% per year. Now, what about the return under Republican presidents? Well, the return under Republican presidents per year over the same data set is 10.1% per year. To that 0.1%, it is almost identical return, which basically means that over a long enough period, as I said before, it doesn't really matter who the president is, because companies who employ CEOs whose job it is to make profits to share with shareholders like you and I, and to ultimately pay their employees for selling widgets and developing in their business and buying and acquiring other firms. People that work in companies and folks that run companies have one motivation. It's no matter who's in charge of the political party, whether it's Congress or certain president, it doesn't really have an impact on the long-term viability of their company. As long as they know the rules to play by, their job is to make profits. So as long as that remains the same, we suspect that the long-term trajectory of growth in stocks should be about the same as it's always been, regardless of which party controls presidency or Congress, whether it's this 4-year election cycle or next 4 or 8-year election cycle. But it's kind of a fun chart because the red and blue stands out. So I've talked a lot about kind of evidence-based investing and thinking about the balance between, markets being efficient or working, right? You and I can't outsmart the market, and neither can the experts. Of course, costs do matter, right? It makes sense. The less you spend on your overall investment vehicles themselves, the more you keep. But also diversification being your friend. We talked about that within kind of the quilt chart that I was mentioning before, where you look at the average, year, and the very best performers within a given year are ranked from top to bottom. But taking it a step further and looking at just the hard evidence of other elements of diversification, 2 things we wanted to point out. First, it's, as I said before, highly unpredictable. This chart displays the last 50 years of time, going all the way back to 1973, and it tries to identify the historical time periods where maybe international stocks outperform US stocks, or where US stocks outperform international stocks. Again, there's no pattern. The pendulum may swing from one side to the other and stay there for a while, but there's really no pattern for what will do best in a given calendar year. So from a philosophical perspective, it might feel good to only invest on one side or the other. If we live in the US, we should just invest in US stocks. But you can see that if you do that, there are periods of time where international can outperform US in one calendar year and sometimes consecutive calendar years. And the same argument can be made if you were only an international stock investor. So the point of this exercise is to really help understate the point that investing in both and having both in your portfolio actually, reduces the risk that you're going to be wrong, right? That you'll have only one side of this in your asset allocation versus the other. But it actually smooths out your volatility risk, because if you have one side doing the zigging and the other side doing the zagging, they can kind of offset each other and you can rebalance against them. So owning both components within a portfolio is important because we don't know, what's going to happen. The overall leadership of the market changes pretty often between both international and US large core stocks. And the same thing can be said about large companies versus small companies. Now, I often think about large companies in the United States or overseas versus small companies in the United States or overseas as thinking about the principle of why they're added to a portfolio. And I often think about this image of a couple of trees sitting in the middle of a field. Large companies are kind of like your fully grown oak trees that produce a lot of acorns, but they've got a lot of staying power. If a tractor is headed straight for that large US company or that fully grown oak tree, chances are that the tractor is going to get hurt and the oak tree is going to be just fine. On the other side of the field, if you have a small sapling, well, the sapling could grow a lot faster than a fully grown oak tree. So it has the propensity to grow a lot faster, but it also comes with a lot more risk. If a tractor runs into it, it's going to get run over. It could be a weather-related issue that tears up that tree. Similarly, large US companies have lots of staying power. They're very mature. Chances are a whole host of them aren't going to go bankrupt because of a recession. Small companies could face those risks. But as this chart kind of illustrates 2 things, again, market leadership changes between large companies outperforming small or small companies outperforming large. But over a long enough period of time, small companies tend to outperform large companies because of the element of being able to grow at a faster clip, regardless of market environment. But sometimes it isn't the case, right? So having both those components in your portfolio from a diversification perspective is also a big part of the overall investment process, as I articulated before with kind of those fundamental investment beliefs. So we talked a lot, Jessica, about balancing these elements of diversification and asset allocation, and boy, all the things we're faced with as investors to make good or bad decisions. I know you have some thoughts strategically on how things could be capitalized to help improve an overall asset allocation, especially during these uncertain times.
Thanks, Jake. As you said, we don't have a crystal ball to tell us how the stock market's going to perform. But what we do control is how we react to the market performance and our ability to implement different strategies to take advantage of whatever the current market conditions are. So a big strategy that we have to deal with, especially during market downturns, would be tax loss harvesting. So in this strategy, an investor would, during a market downturn, sell a position that's at a tax loss. And what you would do is you would take a paper loss for that fund or that stock position, and then you would go ahead and reinvest those proceeds in a similar investment. So you're always staying invested in the market. But what you can do is take advantage of those tax losses, and they can be used to offset any current year capital gains that have already been realized. But what's good about having those losses is that you can deduct $3,000 a year on your income tax return, and then the additional losses over and above that amount can be banked on your tax return and used to offset future year gains. So another topic we're going to talk about here is asset location. And this is a good strategy to help you manage your risk and the return in your portfolio. So this slide showing different investment buckets that you can use to save for retirement. So the first bucket there, the trust or taxable account. So that's your non-retirement assets. So those types of accounts are taxed differently. You'll be taxed on the annual income that those accounts are producing each year. Things like interest and short-term capital gains that would come out of those accounts are taxed as ordinary income. But the good thing about those types of accounts is that qualified dividends and long-term capital gains would be taxed at preferential rates, which are generally lower than your ordinary income tax rate. The second bucket that we have there is your qualified plan. So your 401k or an IRA account, those are taxed pretty similarly. Those types of accounts, you're getting a tax deduction up front when you're putting money into the account. And then those accounts are growing tax deferred until you pull money from them, and then you would realize that is ordinary income. The last bucket there is a Roth account, so either a Roth IRA, or if you have the ability to invest in a Roth 401k through your employer. This bucket is different because you don't get that upfront tax deduction when you put monies into this account. So these after-tax dollars that are in there, they're not taxed along the way. And then when you do eventually pull those monies out for retirement, there's no income tax on that distribution. So when we're looking at asset location, we want to be putting the right types of assets in the right bucket here. So the trust and taxable accounts, you want to put things like stocks because they're going to get that preferential income treatment. And that would, again, be lower than your ordinary income tax. It's also important to possibly have some international exposure in those accounts because you may get a foreign tax credit that can help offset taxes when you file your income tax return each year. But when we're looking at those middle buckets, the qualified plan, 401k or IRA dollars, because that income is being taxed as ordinary income, we want to put assets in those accounts that are also taxed at ordinary income tax rates and kind of keep that taxation similar. So things like REITs, real estate investments, or bonds are the ideal assets to have in those types of accounts because you're going to shelter that ordinary income and the income will be pulled out when you withdraw at the ordinary income tax rates anyways. And kind of the final bucket there with Roth accounts, because these accounts are tax-free and you don't have to worry about paying the tax on that, that's really where we want to shelter those tax nasty investments or the really high growth investments to really get those accounts to grow in that tax-free status. So another strategy that we have would be Roth conversions. So Roth conversions can impact clients who throughout their working career have been saving in a tax deferred vehicle like their IRA or a 401k plan, and you're receiving those income tax deductions while hopefully you're in your highest, earning years. But when we have clients that are retired and no longer receiving income, you might find yourself in a very low tax bracket that you haven't been in a long time. And it could stay that way for a while until you get to the age where you need to start taking required minimum distributions from those accounts. So a market downturn, while it might seem bad for your investments, it might be a great time to do a Roth conversion. So during a depressed market, you could voluntarily take money from your IRA account, pay the tax on it, convert it to a Roth account, and hopefully the market recovery will happen in that Roth bucket and really kind of get extra bang for your buck and with the recovery in the market being in that tax-free account. Market fluctuations are also a great time to think about rebalancing your account. So what rebalancing is really kind of forcing an investor to be disciplined and selling assets when they're at their highs and then reinvesting in assets that are possibly depressed and at a low point in the market. So it's important for investors to use rebalancing to keep their asset allocation in line. So it can be hard, when the stock market's doing really well. So right now the S&P 500 is doing great. We get a lot of questions from investors saying, should I be buying in at the market high now? Everything seems to be doing so well. Well, it probably won't always stay that way, like Jake's quilt chart kind of showed us there. So rebalancing is a way to force you to continue to sell when assets are high and then buy when assets are low. And it really does help to take the emotions out of those trading decisions and helps you stay disciplined. I think this next chart that we're going to show really kind of drives this point home. So this is showing an investor that started out at a 60% stock allocation in 1973. That's that green there. And showing how that portfolio would kind of morph over time due to market growth. So as stocks, continue to outperform bonds during this time period, and an original portfolio with 60% stocks would end up being closer to 90% stock allocation if you never rebalance along the way. And that might not be your target allocation. It might be too risky for you. So it really is important, especially, during market fluctuations, to take advantage of rebalancing. So during the uncertainty in stock markets, it can be really easy to make irrational investment decisions. I know Jake mentioned the downturn during the COVID pandemic. That really did rattle investors and made people possibly want to make bad decisions regarding their investments and causing them to sell during a low point in the market. And as Jake showed, that can really impact your long-term return of your investments if you're selling out at that low point and not getting back in at the right time. Again, on the other hand, you could feel very euphoric about the market and be buying when the market's high. So we really want to make sure that we're focusing on the things that you can control, like your financial goals. So at Savant, we really do focus on what are your underlying core values and goals in order to figure out what your financial plan and asset allocation for your investments should be. Once you determine what is really important to you, then we can kind of build out what your financial plan looks like. We can set goals and put things in place to get you where you want to be long term. So when we're thinking about goal setting, it really is going to impact how you're investing your financial resources in order to achieve your specific vision and goals for your life. So a really big thing is determining some SMART goals. So those would be specific, measurable, achievable, relevant, and time-bound goals. So you could really hold yourself accountable if your financial goals are really fleshed out. And by setting goals, you're also setting yourself up to be prepared for life events that will happen in the future. So you know that you're making the right decision based on your plan and not based on what the market performance is. And it's just really important to stick to those goals, especially during times of market fluctuation, because you don't, like Jay said, kind of want to shoot yourself in the foot and make a bad investment decision that will impact your long-term financial goals. I know we've talked about asset allocation, but it is still the most important decision that you will make when determining how to invest. You definitely want to pick the right mix of stocks to bonds to cash or alternatives when you're starting your goal setting process. And don't let the uncertainty of the stock market make you change your asset allocation out of fear, or on the other side, possibly out of greed. You want to stick to your long-term plan, and that's all based on your financial goals. So looking here at an efficient frontier, this kind of plots out different asset allocations for different portfolios. You can see on the bottom left, those portfolios that are more yellow are the portfolios that are more heavily invested in bonds and come with lower risk. And as you move up that efficient frontier, you're adding in more stock allocation and more risk as you go along that curve. But you want to determine, your goals and your financial plan and really drill into which of those portfolio makes sense for you at that point in your life. And that can change, as you're going from your working years to retirement years. You will have some changes to your efficient frontier. But that should be based on what your set established goals are and not really so much what the market performance is doing on a day-to-day basis. Jake, if somebody is thinking about structuring their asset allocation, can you give me some ideas of how you would assess their investment priorities?
Absolutely. Yeah, this framework is very flexible, to your point, and most of it should be rooted kind of in the financial plan, as I'll talk about in just a second here. But take an example of someone that's 80 years old, perhaps has utilized their portfolio for cash flow for a long period of time, but still has maybe a 10 to 15-year time horizon. But say, for example, they rely upon their portfolio for very little income relative to their means. Well, I think the old rule of thumb would say an 80-year-old that is maybe only a 10 to 15-year time horizon should have a much more defensible or conservative asset allocation. So one of the old rules of thumb, which is far past broken now, was take 100 minus your age, so 100 minus 80, and that tells you how much in stocks you should have in your portfolio. Well, the argument for that 80-year-old would be, well, you should have 20% of your money in stocks. But thinking about that fact pattern again, in that scenario, if you have an 80-year-old that doesn't need much of their portfolio for income, perhaps still has a decent time horizon, or maybe has kids or grandkids from a legacy goal perspective that they want to leave that money to, well, maybe their time horizon and their legacy goals should influence more of the decision of their asset allocation, if maybe we're more aggressive or conservative they should be. So perhaps in that scenario, the argument could be made, well, hey, the 80-year-old could be very aggressive because if they don't need the money during their lifetime, and really we're looking at a much longer time horizon, and it's important to them from a goal setting process to leave a large legacy to their family, it's a great example of someone that should be, well, maybe 70, 80% stocks instead of 20 to 30% stocks. But the same could be said the other direction. If someone is very comfortable with their asset allocation, and doesn't have much income need, but prefers peace of mind, maybe sleep a little bit better at night, especially during uncertain times, if they'd be prone to making a bad decision, should they have a more aggressive asset allocation, it's a great reason to kind of dial back risk in your portfolio because it might help you be a little bit more balanced and be more disciplined during that process. So that discussion, Jessica, of asset allocation and thinking about goal setting and how it relates to your financial plan is critical to kind of thinking about those priorities. So thinking about kind of investment priorities, we always like to zoom out with this topic. It's hard to do it when you go through like an example like this. I think we've all been on a roller coaster or some kind of theme park ride before, but this kind of framework exists within one day in financial markets. It exists within 1 month. It exists within 1 year period of time, even over a 3 or 4 year period of time. We call this the kind of cycle of market emotions. When we're coming out of a recession, for an example, or if coming out of the COVID pandemic was a great example of this framework. We had a lot of optimism. It's like, oh, okay, we're not going to be in our houses for months and months and years on end because of a major health catastrophe. And then, okay, the economy is going to get back on its footing. And then we got to a point in the summer of 2020 that tech stocks were trading at all-time highs. There was even reports of folks quitting their jobs and actually buying companies over the summer because it was easy to make money. That point of euphoria is actually when there's the most financial risk. It's kind of opposite. When it feels the best is when it's riskiest. And when it feels awful, so you ride that roller coaster down and you come to the point of despondency, that's actually the point of best opportunity. I mean, I think it makes sense intuitively. If stocks are priced really high and it feels really good, it's like, when's the other shoe going to drop? But then the argument on the other side is, boy, when things are down, most human beings aren't throwing a lot of money back into the markets when markets are down so significantly. Your average investor isn't doing that because that doesn't feel very good. But when it doesn't feel good is when there's the most opportunity. And when it feels great is when there's too much risk. So, a job as a financial advisor with coaching clients through this exercise is try to help them stay in the middle. Because there'll be periods of euphoria and despondency that you can get to. But if you stick to that plan, and Jessica, like you said before, related to kind of the overall vision of what's most important to you, can help ride this framework a little bit smoother and not be subject to an undisciplined process of trying to buy in or sell out, at potentially the wrong time. But zooming out is kind of where this planning process is built. So, this framework, when you think about all 10 key financial planning disciplines, which not all 10 apply to every single, person or relationship, but you can see that investments are just a portion of the overall plan. We would argue the investments are the most boring portion of the overall plan, because once you have a plan and a process that's actually related to these other areas, then all you have to do is reevaluate and confirm that. But understanding that in a, kind of a discipline where we're going through an assessment like this with somebody, understanding that retirement planning, what you plan for your future or today, is related to how much risk you take in your investments. And Jessica, as you pointed out, if in your investments you're going through periods of uncertainty, there might be tax planning opportunities to capitalize on. Or, with investments, if it's important to you from a goals perspective to allocate money to charity, for example, well, when markets are really good, it's a great opportunity to make gifts to charity out of your investment portfolio. But it's kind of this interdisciplinary approach from a financial planning process that I think can ground you a bit in periods of uncertainty when we're going through changes in investment market or changes with political elections, whatever it might be. Kind of zooming back out and trying to understand how your investment decision will relate to the rest of your financial plan is part of the coaching, right, that advisors can provide throughout that process to really help you understand what those priorities should be. Because we understand that, while markets will give you ups and downs, life gives you ups and downs as well, right? Some things are really positive and good. Obviously, things are unexpected and sometimes very poor. And so helping to navigate through these critical financial events is really what coming back to that financial planning process look like, and how you integrate investments with that, to help you ride through this kind of path in life. You've only done this once, right? Where usually an advisor has helped hundreds of people navigate this path through life in lots of different ways. And the collective wisdom that we gathered to help advise you on decisions you should or shouldn't make, especially when it comes to, should I make a decision with my investment portfolio to do this or to that, comes back to, obviously what we can share and gives you the most progress towards maintaining the financial plan that you have in place and giving you the most amount of discipline that we can encourage you to have. So again, why all of this is important? Well, I think at the beginning, we talked a lot about, those core fundamental investment beliefs. And I think discipline being a big part of that. But all of these different elements of asset allocation, diversification, managing tax planning opportunities, zooming out kind of on the financial plan helps you to eliminate unnecessary risk, reduce return or reduce risk and increase potential return. Ultimately, it's to deliver peace of mind, and the thing we all pursue on a daily basis, especially from a financial planning perspective. I think in summary, it's all the things about what you can control or you can't control. If it's something you can control, right, you got to think about that decision tree of, okay, is the market, if it's down today, is that something I can control? Well, if you can't control that, well, you have to make some different decisions. But if you can't control it, well, here are things you can consider, right? Thinking about the fundamentals, looking at evidence and data, thinking about those tax planning opportunities, getting in touch with your advisor to help them, understand where your needs are so they can properly counsel you on your own process and what that might mean for your investment allocation. Because the things on the left side oftentimes lead to worse outcomes for your financial situation than better. You can get lucky, but a lot of times you don't. So early on, I mentioned about questions and answers, and certainly we're going to get to a couple here that are in the chat. But if you have things that are specific or unique to your situation, there's a link that's down in the Q&A box that you can click, which can schedule, free introductory call with us just to kind of get an understanding of what's most important to you or unique or specific questions that you have. We'd love to connect with you and we'd be grateful for that opportunity. Now, we would like to address a few questions that have been submitted through today's presentation. So let me peruse the box here and try to identify some ones that I think will be pertinent and relevant for us. Jessica, here's a good one. I think makes me a little bit anxious because the last 4 to 6 weeks have been getting consistent text messages from political candidates asking for donations, but just having technology at your fingertips. So the question is, how does the use of technology and the 24-hour news cycle affect investor behavior? What thoughts do you have on that?
Yeah, I guess it's so hard when we have so many channels dedicated to 24-hour news cycles. And like you said, you've got your phone in your pocket and that's giving you alerts, and you've got all that data at your fingertips, and it can be overwhelming. And just, kind of going back to your investor, emotional cycle there, it can really, send you up and down that cycle, like you said, even daily. So for me, I would just recommend trying to tune it out as much as you can. There's so much information there, but it's really is sticking to the basics, having that plan set up front based on what your individual needs and goals are. And does that day-to-day fluctuation in the market and all that news really impact you? Probably not. I mean, I think if it's worrying you and you're staying up at night worried about your investments, well, that's probably the time to pick up the phone and call your financial advisor and say, maybe I'm not in the right investment portfolio. Maybe my asset allocation doesn't match my goals and my values. And that would be a time to talk about a change. But it's really trying to tune out all that unnecessary noise and letting the fundamentals of your plan lead the way.
It's a great point. Yeah, it's tuning it out, I think is the most important thing that I was just listening and hearing you say. It's hard, really hard to do when it's constantly in our face. But the more you do that, the less likely you are to make a decision. Because a lot of times, when you're tuning into those things, between the arguments that are made by different pundits, I think a lot of times what comes out of that as well, they're looking to also sell you an advertisement or something else that might come along with some of those commentary. So another question, which I can take this one, how will my portfolio be able to weather changes in interest rates from the Federal Reserve? So this is a very timely question because tomorrow, actually, the Federal Reserve's likely to meet and likely to decrease interest rate targets again. If you remember going back to 2022, there was a substantial increase in interest rates because we had been at zero from the pandemic. And it was actually the fastest interest rate increase we've had in 75 years. And it stayed high for a while to hopefully curb inflation. And now that the economy has continued to churn well, wage growth is still strong. The Federal Reserve's kind of begun this course of reducing rates to get to a more sustained normal. So getting to kind of 3 to 4% is the target for where they want to ultimately hold interest rates. Now, how it affects your portfolio? Well, a couple things. Number one, you'll get less interest for holding money in bank deposits. So to the extent you've got bank deposits that are there for emergency funds and day-to-day cash needs, that's not a concern. But if you've been holding lots of cash on the sidelines, waiting for the right moment to invest it, hopefully you've learned a little bit here today about that, but likely to get less interest in the bank. But one of the byproducts of lower interest rates is actually increasing bond prices. So bonds were hurt significantly during 2022 and 23 as an adjustment was made. As interest rates go up, bond prices go down. It's kind of like a teeter-totter. But now all those bonds, have a higher rate of interest, and so those bonds are actually worth more if you own those today. So if interest rates come back down, the bonds that someone owns today, which are paying more like 5.5%, if a new bond only pays them 4.5%, the bonds you own are worth more, and so the prices get adjusted upwards. So it should mean good things for the bond market over the next 2 to 3 years. And on the stock side, generally, if there is less cash interest that people are earning for holding money in safe, secured, investment or bank accounts, people often seek yield for that. So they take funds out of the bank if it's not otherwise used for short-term purposes, and oftentimes can deploy that in the investment market. So it's some of the time it can result in kind of a boon from an investment growth perspective as well in stocks. So we'll see what happens in that regard. And then I think the last question we'll take today. I guess specifically, Jessica, this is about kind of the rebalancing process. So it's a question about what specifically is kind of happening during a typical rebalance process. When does, I guess Savant kind of look at that?
Yeah, so I think it's important, to keep an eye on things. Right now, like we've talked about, the S&P 500 is doing so good. The stock side is doing so great right now. So us as advisors, we're taking a look at portfolios and making sure they're staying within the target that we want them to be. Again, coming back to your personal asset allocation, and just seeing, once that gets to about 3% out of balance, well, then we definitely want to keep a closer eye on things. If we start drifting a little bit more, maybe now stocks are more than 5% overweight, well, then we might want to consider doing some rebalancing in your account. There are a lot of things that go along with that could have a tax impact. If you're pulling funds out of your accounts to provide cash flow, well, maybe we kind of look at where we're pulling money from in order to create that cash flow to try to get your portfolio a little bit better in balance. But it's something that's definitely ongoing. I would say at least annually we should be looking to make sure that your accounts are rebalanced. I know if you do still have a 401k with your employer, I know a lot of times they'll have options in there where you can rebalance, automatically, either quarterly or annually, and just kind of set that up so you can take that emotional decision out of rebalancing the portfolio.
Those are all great points. Well said. Well, that is all the time we have for questions today. But if your specific question did not get answered, go ahead and add that into the survey that'll pop up after the webinar. We'll be sure to give it attention. And of course, if there's at any time you're looking for more information about Savant, about what we do, certainly would invite you to savantwealth.com to learn more, or like I mentioned before, schedule that 15-minute complimentary call with us. Certainly appreciate your time and attention. Thanks so much for joining us. Hopefully, as time goes forward, uncertain times will become more certain times, and have a great rest of your day. Thanks a lot.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.